Hello everyone. In this video, we are going to go over another example of creating an income statement and balance sheet pro forma. So you should have this file Excel financial statement pro formas open, and we will be working on this step today that's called pro forma to do. You will be creating this income statement and balance sheet pro forma right here. And you can double check your work by clicking on this pro forma solved tab and seeing the completed assignment. Before we get started, you should look on My Financial Statements tab, and you should have all of this information because you created it in the previous videos. If you have not done that yet, please go back and watch the videos. It is especially important to go through this example right here because it helps you understand what's going to happen in our next example. So in our previous example, you created an income statement pro forma right here, assuming a growth of 10% for next year, and a balance sheet pro forma that reflects that support for the 10% growth in sales for next year. And the firm generated $3.8 million in internal financing, and that was just enough to cover the 10% growth, meaning the internal growth rate for this firm was 10%. How do I know that? Because my total assets next year equals liabilities and shareholders' equity. There is no difference between the two in my next year projection, meaning that my internal financing is enough to cover the 10% growth. You can play around with this growth rate and change it to 20%. At 20%, you can see that your internally generated cash is higher. However, your assets also are growing by a larger amount to support the growth in sales that's now bigger at 20%. And you can see that your total assets at 48 million next year exceed your projection for next year, liabilities and shareholders' equity of $44.6 million by $3.4 million. This means the firm needs external funds. This means this firm will need to raise debt in the amount of $3.4 million. How will it raise debt? Following maturity matching, it will raise short-term and long-term debt because this firm experienced an increase in both its short-term assets and long-term assets. Alternatively, if you change this growth rate to 5%, so the firm is not growing as fast, you can see that it's generating slightly less in internal financing, but the assets are not growing as fast. They only need to get to $42 million. And your liabilities and shareholders' equity exceeds that amount. So your internally generated funds, this $3.6 million, is more than enough to cover the 5% projected growth for next year. You actually have $1.7 million left over, and you'll have to figure out what to do with this extra money. But that's for another video. Let's get started with our pro forma to do. We're going to create another pro forma similar to this, so we're getting started on our next example. Let's go ahead and click away our ribbon so that we have a full view here. In this example, your sales growth will be 20%. You're already given the historical information. This is what happened last year. You have last year's income statement and last year's balance sheet. You're also told that your taxes are 35% of taxable income. Your dividend payout ratio is 30%. So the firm is paying out 30% of their net income as dividends, and your retained earnings are therefore the remainder, or 100 minus 30, 70%. Let's jump right into it. First, sales are growing at 20%, so that's going to be the easiest one. But many of the accounts on the income statement are also going to grow with sales. And it makes sense because as you sell more canoes, shirts, whatever your product is, you will need to have more costs associated with the sales of that product. So we're going to assume in the simple case that the cost of goods sold also grows with sales at, in this case, 20%. Next, we have other expenses. Other expenses, we will assume, will also grow with sales at 20% because it again makes sense. As you produce more shirts, you need to use more electricity and to support your sales and utilities, for example. Next, we have EBIT, earnings before interest and taxes. That's going to be your sales minus your costs, both main costs and other expenses. So our EBIT is next year projected to be $204,600. Interest expense. Okay, interest expense is an account related to external financing. And remember, the whole goal of us creating this next year pro forma is to understand whether the firm will need external financing. In other words, will the firm need to borrow money through short-term debt and or long-term debt next year? They need to prepare before they go and talk to their banker. So because of that, in step one pro forma statements, we keep external fund accounts unchanged. It could create a disbalanced balance sheet just for a while to help us understand whether a firm needs external funds or if it has extra cash. And then in step two, we're going to balance our pro forma statements and either borrow money or figure out what to do with the extra cash. So all of the external financing accounts are going to stay unchanged from the previous year. So I'm going to actually go ahead and mark through all of them. Interest expense is one of them. My external financing accounts are debt and equity, specifically short-term debt and a long-term debt. And with equity, I have common stock. So I have already filled out some information on my balance sheet pro forma, but that's because I wanted all of my external financing accounts to be the same as last year, unchanged, because I want to understand, do I actually need to borrow more money next year to support this 20% growth? Taxable income is my EBIT minus my interest expense. Taxes are going to be 35% of taxable income. I pay taxes on my taxable income, and firms do, and individuals do. Net income, the biggest sub-summary on the income statement, is $124,865. I'm going to pay out 30% of that to my shareholders. So what remains? What remains is what's reinvested in the business, or 70% of this. 87,406. This is the amount of your internally generated funds. Why are they internally generated? Because you have your sales of your shirts minus all of the related costs. And this is what remains. And these retained earnings are reinvested back into the business. And they're going to get added to the balance sheet right here. Because a balance sheet is a cumulative statement, you're going to take the previous year's retained earnings and add the next year's projection of retained earnings from the income statement to it. So the first account that we will create, outside of external accounts on the balance sheet is the internal funding account, where we will take previous year's retained earnings plus this year's projected retained earnings. That's your next year projection for the retained earnings account. Next, let's go ahead and look at all of our asset accounts. As a matter of fact, asset accounts will be growing with sales in this simple pro forma. Why? Because as you sell more shirts, you will need to give more credit to your customers. You'll need to have more inventory, so this will cause all of these accounts to grow. You will also need to have more sewing machines, which will cause your net fixed asset or property, plant, and equipment to grow. Finally, because you have more inventory and you're making more shirts, you will need more credit from your suppliers. Accounts receivable, inventory, and accounts payable are operating working capital accounts, and they will always grow with sales. As sales go up, you will give more credit to your customers, accounts receivable go up, you will have more inventories go up, and you will take more credit from your suppliers, accounts payable will go up. So let's go ahead and create the income statement pro forma for next year. Cash, we're going to assume in this simple example, is growing at 20% with sales. Accounts receivable are also growing at 20% with sales. Some of you might want to, feeling comfortable, might want to copy the formula instead of typing it in over and over again. To do that, you want to log the cell reference for your 20%. In this case, you can copy and paste the formula, and it's just going to update all of the numbers. So your inventory is going from 79,000 to 94,800 growing to support higher sales. So what are my total current assets? It's a sum of all of my current assets, and we can see how that's increased. My net fixed assets, which is my equipment and sewing machines, they're growing at 20% with sales because I was using all of my sewing machines. And as I need to sew more shirts, I need more sewing machines. So you can see that this account increased by itself by $75,000. So it's taking up a big portion of this increase in retained earnings right here. So my overall total assets, which is my current assets plus net fixed assets, is going to be $600,000, $16,000, and $800. Let's take a look at the liabilities and shareholders' equity side of the balance sheet. But before we do, you can already see that the increase in total assets is higher than $100,000. So you're probably already getting an idea that it's likely that the firm will need to borrow money, will need external funds. But let's double check because some of the money will come from your suppliers. So the accounts payable or the credit from your suppliers is going to grow at 20%, again, because they will give you more credit as you buy more material from them. We already said that notes payable isn't changed, so my total current liabilities are $89,400, a sum of accounts payable and notes payable. My short-term debt remains unchanged, and my total leverage is my current liabilities plus my long-term debt. My common stock remains unchanged, and my retained earnings, my retained earnings, I put that in the wrong column. So let's just go ahead and redo that. And we're going to take this and add back the retained earnings from the income statement. So my total owner's equity is the sum of common stock and retained earnings. Total liabilities and shareholders' equity is going to be my total debt plus owner's equity, a lot of sub-summaries on this balance sheet. And we can see that our total assets next year at $616.8 thousand are greater than our liabilities and shareholders' equity at $613,806,000 by 2,995, or if the numbers are in million, by $2.9 million. Total assets next year in the projection being higher than your liabilities and shareholders' equity suggests that this firm will need to borrow money. It has a need for external funds of $2.9 million approximately. That's all for this video, and in the next video, we're going to look at some variations of what happens to various balance sheet accounts.